Welcome to today's Explainer. Over the last decade, Vietnam has absolutely exploded as one of the fastest growing economies in Asia, pulling in billions in foreign direct investment year after year. But if you follow global finance or emerging markets, you already know that doing business across borders usually means learning a completely new language. And I'm not talking about Vietnamese or English here. I'm talking about the language of accounting. So today, we're unpacking a monumental regulatory transition happening right now: Vietnam's shift from its localized accounting dialect to the universal language of global business. We're going to dive into exactly how and why Vietnam is moving from its legacy system straight into international financial reporting standards. Here's our roadmap for today. We'll be covering Vietnam's accounting evolution, rules versus principles, contrasting asset treatments, the adoption timeline, and finally, the impact on international investors. Okay, let's dive into this with Section 1, Vietnam's accounting evolution. Picture this. You're a multinational corporation looking to invest heavily in Vietnam. You ask to see a local company's books, and suddenly, nothing adds up the way you expect it to. The numbers are all there, sure, but the rules governing those numbers are completely different from what you'd see in London, New York, or Singapore. So, why is Vietnam fundamentally changing its accounting standards? Well, because right now, multinational corporations are spending massive amounts of time and money just trying to decode Vietnamese financial statements so they can consolidate them for their parent companies. To really grasp the problem, we have to look at the current setup. VAS, or Vietnamese Accounting Standards, is the mandatory set of rules for most enterprises operating in Vietnam today. It was developed by the Ministry of Finance. But here's the catch. It is heavily influenced by local tax regulations and is based on much older versions of international accounting standards. In fact, it hasn't had a major update since 2005. It's essentially a localized dialect that prioritizes strict tax compliance over actually providing a clear picture of a company's true economic health to global investors. Moving right along to Section 2, Rules versus Principles. And this brilliantly illustrates the philosophical shift at the absolute heart of this regulatory transition. Notice how VAS is rules-based. It applies specific, prescriptive, and honestly very rigid rules. It tells you exactly what to do, largely so the government can calculate taxes easily. Now, contrast that with IFRS, which is principles-based. It requires accountants to use their professional judgment to reflect what is actually happening economically. It's no longer just about taking a compliance box. It's about accurately portraying real-world financial substance of a business deal. To really hammer this home, listen to this exact quote drawn directly from our source material. VAS focuses on compliance and tax alignment, while the new standards emphasize the economic substance of transactions. This isn't just some minor technical tweak or a simple software update, guys. It is a completely new way of translating business reality into numbers. It literally shifts the power away from a rigid government checklist and puts it into the professional judgment of financial experts. Let's move on and see how this builds in Section 3, Contrasting Asset Treatments. Now, what's really interesting about this is how drastically asset valuation changes between the two systems. Notice how VAS strictly uses historical cost. Basically, what you paid for the asset on day one is what stays on the books forever. But IFRS emphasizes fair value, requiring regular revaluation to reflect current market conditions. And look at asset impairment. VAS generally doesn't even require you to recognize impairment losses for fixed assets if their value drops. IFRS, it absolutely mandates impairment testing. If an asset loses value, you must write it down, no exceptions. And then there's this number, 10. This is such a fascinating quirk of the legacy system. Under the current Vietnamese accounting standards, 10 is the maximum number of years over which a company can amortize or spread out the cost of goodwill. This means a company is literally forced to report a steady expense year after year, which artificially lowers their reported profits. Under IFRS, goodwill is never amortized. Instead, it's subject to a mandatory annual impairment review. If the value hasn't dropped, there is zero expense recorded. This one single difference completely alters how expenses and profits look on a spreadsheet. Let's look at one more major technical difference, and that's leases. Under VAS, companies can distinguish between an operating lease and a finance lease. Operating leases are kept entirely off the balance sheet, which can make a company look like it has way less debt than it actually does. But contrast that with IFRS 16. There's a single model. Nearly all leases must be recognized directly on the balance sheet as an asset and a liability. It entirely eliminates those old off-balance sheet tricks, meaning a company's true debt simply cannot be hidden anymore. So when is this all happening? Let's hit Section 4, the adoption timeline. Notice the deliberate, phased approach the Ministry of Finance is taking here. Like we mentioned, the last major update to VAS was way back in 2005. Right now, between 2022 and 2025, we're in a voluntary application phase for large entities. Think state-owned enterprises and listed companies. Post-2025, IFRS becomes compulsory for those large enterprises. But notice that last milestone, January 1st, 2026. That is the anticipated effective date for something called VFRS. So what exactly is VFRS? Well, it's a planned, simplified national adaptation of IFRS. Why is this even necessary? Because full IFRS is incredibly complex and resource-intensive. Mandating the whole thing for every small and medium-sized enterprise in Vietnam would completely crush them with training and system costs. So VFRS acts as a bridge. It shifts local businesses to a modernized, principles-based framework that aligns with global standards, but it simplifies or just totally omits the most complex parts, like niche hedge accounting rules. It's a remarkably pragmatic solution for a rapidly growing economy. Which brings us to the big picture. In Section 5, Impact on International Investors. So the crucial point is this. Because of legacy rules like having zero impairment testing and hiding leases off balance sheet, Vietnamese financial statements often show inflated asset values and artificially lower reported expenses compared to international norms. On top of that, complex transactions like financial derivatives are barely even covered. For foreign investors, this means the financial realities are totally distorted. Right now, they have to perform costly, time-consuming reconciliation adjustments just to understand what it is they're buying or partnering with. And that leads us to the ultimate goal of this entire massive regulatory undertaking: increasing transparency and comparability for international investors. By adopting IFRS for large companies and VFRS for everyone else, Vietnam is eliminating those painful translation costs. A CFO sitting in London or Tokyo will very soon be able to look at a Vietnamese balance sheet and immediately understand the economic reality of that business, trusting for sure that it was prepared using the exact same principles they use back home. As Vietnam positions itself as a central hub for global manufacturing and services, speaking the universal language of business is no longer optional. It's a prerequisite for growth. Which leaves us with this final thought to consider. As these barriers of financial translation are finally removed, how will complete financial fluency reshape the flow of foreign direct investment into Vietnam's rapidly integrating economy? It is a massive shift, and definitely one we'll be watching closely. Thank you for joining me for this explainer, and keep learning.